Hannah Kesler.
This gal started her own bank at the age of 18, and then you became a self-made millionaire by the age of 24?
I did.
Hannah Kesler is a money mentor.
She's known as the single millionaire chick.
With advice on how to stop living paycheck to paycheck.
Money
Starts with your mindset.
How you think about your money is going to greatly impact how much money that you have.
I grew up in a town called Olathe, Kansas. I'd be walking out of the door, going to school, and my mama would holler at me, "Hannah, make good choices." And I'd have to holler back, "Because the choices I make today will affect my future."
My parents, they did a very good job about teaching me as a child how to handle my money.
We have a lack of understanding when it comes to money.
If you want your kids to have money, you need to start talking to them about it while they're young.
I'm really second generation to this concept that's called the infinite banking concept.
And at 18 years old, my dad gave me the choice to start my own bank that then led me to becoming a millionaire by the time I was 24.
Now you've written a book to help tie it all together.
So the companion is really just teaching kids that, not specifically money, but really important life lessons.
Now being the owner of the Money Multiplier, I help serve over 17,000 clients in every state of the country.
Where can people get the book?
HannahKesler.com. Hannah spelled the same way forwards and backwards, Kesler with one S.
Also, I got my podcast show, the Money Multiplier Podcast.
And make good choices today, because the choices you make today will affect your future. Good morning. Happy Thursday, everyone. It is the last Thursday in August. Summer is coming to an end. We are closing out the summer months. So we, as a family, I'm reporting to y'all live from the Florida Keys. We're down here in Marathon, so about an hour north of Key West, Florida. And we come here every year, and more specifically, we're here talking about our wealth in the family banking system, but also it's lobster season, okay? So we've been going out, we've been diving for the lobster, we've been, Zach and Summer, so they've been going out and doing their mahi fishing and then even fishing for grouper. And I've been tagging along, kind of going with them and seeing the adventures. Will I go with them? Absolutely, and I'll snorkel around. I don't dive myself, okay, when they're going down and grabbing it with their little ticklers with the lobster. But what's kind of fun is that I'll go around and snorkel on top of them, and then just kind of hang around the boat, and I'll read my book and get a nice tan on. So this is day 5 of the family trip down here. We got a few more days, and we've been catching some good fish. So actually, one of our meals over dinner one of the evenings was lobster with steak and Brussels sprouts. So y'all, we've been eating good over here. I think tonight we're going to go out. I really want to go and play a round of mini golf with the family. I think that would be a lot of fun. And then maybe after, go get some ice cream cones or something. So I think that's going to be our game plan for this evening. So how are y'all doing? Is your week going well? Are you guys having fun? Okay, because at the end of the day, that's what this life is all about. Are you having some fun? So today I have some topics I do want to get into, specifically how to build your family bank. I thought it was just a great time to bring up this conversation again, especially over this week that I'm here with the family. And I want to talk to y'all about how we're implementing becoming our own bankers and building the family bank just within our Kesler family. Okay, because quick background, right? It was my dad that learned about this concept, the infinite banking concept, how to become your own banker. And he learned about this back in 2006. He was at a chiropractic convention because, long story short, dad was a chiropractor. Okay, that's what him and mom started off with when we were living in Kansas City, when they first moved there from St. Louis to Kansas City to settle down, raise Zach and I, and then start up the chiropractic offices. So dad, furthering his education, seeing how he can make more money within the chiropractic business, he was at a chiropractic convention. And there was a guy up on stage teaching about this infinite banking concept. And dad, he thought it was too good to be true. All right. He was a naysayer. He was sitting in the audience. He had his arms crossed and he goes, man, that stuff looks good, but it kind of looks just too good to be true. So he didn't do anything with this information when he first learned about it. And like a lot of y'all, okay, because I'm having conversations with you guys, you learn about this and then you sit on it for a year, 2 years, 7, 10 years. And then you come back around and you're like, Hannah, I've heard about this before. I just never started. And you know the number one thing that y'all tell me? Okay, if I had $1 for every time somebody told me this sentence, Hannah, I wish I would have known about this at your age, or I wish I would have started this stuff 20 years ago. I would be in a total different financial position than where I'm at today. If I had $1 for every time I heard that, y'all, I wouldn't be doing this morning show. My butt would be down in Mexico drinking a margarita every day. Okay. I'm just kidding. But seriously, I hear it a lot. So dad, luckily, all right, he learned about this in 2006, never took action. And then it was 2008 when he went back to that same chiropractic convention. And he had his colleagues, his friends, even, one of his friends, their mom works with us over here at the Money Multiplier. We've developed deep relationships from the chiropractic days. But dad had a lot of friends and chiropractic colleagues who came up to him 2 years later in 2008 at that next chiropractic convention. And they're like, Brent, this stuff is amazing. I mean, we're paying our payroll through the policies. We're financing for the adjustment table, the diagnostic equipment for the office. Maybe you're out there selling isogenics or the pH balanced water in your office, So they had all of these expenses and they actually took action with this system when dad never did. And so that's when dad was like, okay, there's got to be something to this. I mean, there's no way this many people that I trust and are successful who are doing this and raving about it. I think I got to look at this deeper and I got to maybe start taking some action here. So that's how we all got involved, was back in 2008. And that's when dad started his first policy. And back then he had a crap load of debt. He was running the offices. He has debt from the chiropractic office. He had houses. He had boats and wave runners, and he was a pilot, and so he just tackled on all of this debt, and he was making good money. He just wasn't keeping the money that he was making because he was going out to other people first. That money already had a job somewhere else. He already promised the debt people those monies. So that's where we started with all of this stuff, was paying off the debt mom and dad had. And then from there, that's when they started to wealth build, essentially. They were expanding their businesses. They started more offices. They started to invest into real estate. And they even started to use it to finance for stuff for us, like us kids, I was playing volleyball. Okay. Club volleyball, y'all, you don't realize it as a kid, but oh my goodness, when kids want to do club sports, it's expensive. Like I'm seeing that with my niece, Tori, right now, because she's very deep into her cheer stuff. And she's a senior in high school this year. So she's coaching some of the younger cheer teams, right? And it is expensive. The uniforms, the bows, the bags, the travel to all these competitions. I was like, holy crap, mom and dad, I'm grateful. Thank you for allowing us to do that as extracurricular activities as we were growing up. But they were using the system to finance for these purchases. And so we just kept building. So now fast forward to 2026, mom and dad, they have their policies, right? Over the course of that time, I've started policies. Zach has started policies. My older brother, Sean, has started policies, and we just keep expanding and building this family banking system. Because here's the thing that it comes down to. Your wealth and your money has to be stored somewhere, right? You can keep it at the bank. Why do we keep money at the bank? Well, I don't know. That's just where they keep the money at, right? I remember we were actually just talking about it last night at dinner, going down. Okay, because here's how it came up, right? We're looking over all of our assets and stuff, and I was looking over mine, and I noticed that one of my bank accounts, it was my first ever bank account that I opened up when I started working at 14 years old. It was that bank in the Price Chopper. Okay, it was US Bank right there. I'm visualizing it. I can see it in my head when we were growing up in Kansas City. And mom went with me. She sat down and we opened up my first checking account together because I was working and I needed a place to warehouse that money at. And come to find out, now at 27 years old, I opened that first bank account when I was 14. My mom is still listed as an owner of that bank account. She's a co-owner on it. And so mom and dad are making the jokes. They're like, hey, we have some of your money. We're just playing over here, right? So why did I get into that? So mom is kind of owner on that bank account. Anyways, we're just looking over our assets and where things are at, right? I got to get that change, mom. Okay, you got to get off of that thing. But your wealth has to be stored somewhere, right? So that first bank account that I had, that's where I was putting my money at. And then when I was 18, dad says, hey, now that you're 18, you can own your own policy. The first thing that you're going to do is you're going to start your own bank. All right. And I'm not talking the conventional bank, okay, or putting a vault in the backyard. I'm talking about creating a banking system. And how we do that is we utilize whole life insurance policies. And the whole life policy has to be designed specifically for high immediate cash value. Okay. So I wanted to give y'all a visual of this, all right? And I kind of put something together here today. But most times when people are talking about life insurance and specifically whole life insurance, they're designing that policy specifically and only for death benefit protection and purposes. They're not walking into it intentionally, building it to be a banking system so that when I put money, my premium inside of this policy, that immediately there's cash value in there. And that cash value, that's what I can take out and start using now to finance for the purchases that I'm buying within my life. All right. Here, let me add this to the stage for a second. You see my little screen? Open. I see some comments coming in. Hold on. Fern saying good morning. Annette, good to see you. Dexter says, hello, everyone. Hello, Miss Hannah. Spelled same way, forwards as backwards. Yes, sir. A polydrone. All right. So do you see my chart here? Let me get to it on my page on my screen. Here we go. Okay. I want you to visualize this thing as like your policy has 3 buckets, because sometimes people will get confused when they're paying premiums, how much cash becomes available when you're paying back your policy loans, what bucket does that money go into? So I kind of want to give you these specific lanes or buckets, if you will, of how the policy is operating and what you're doing when you're paying the premiums. How does the cash become available to us? How much? And then, don't forget, y'all, this is still a life insurance policy. There is still a death benefit on this policy, whether we want it or not. There's always going to be a death benefit on this policy. But I know our first intention is to walk into this thing as being able to use this as our banking system. So it really kills the 2 birds with 1 stone, because, hey, Nelson Nash would say this all the time. He says, if I can solve your need for finance and cash during your lifetime, you will have enough and plenty of death benefit to leave to your family and heirs. So that's what I'm solving. I'm solving the need for the finance, the cash, the banking function in my life. And then the death benefit is just the cherry on top of the cake. So premiums, okay? First bucket right here, our red bucket. This is the out-of-pocket money that you're putting in to your policy, this premium deposit. I call it a deposit, okay, because it really gets my mind geared into thinking about this as me being my own banker. And also, I think of it as a deposit because when money goes inside of this account, this policy, and I immediately, my definition of immediately is within 30 days, have cash value in here that I can take out and start using for whatever I want. I think of the premium more as a deposit rather than a payment. A payment to me is like I'm paying for something, I'm never going to see it again. And I'm paying in exchange for the service, the product, whatever I'm buying. So I think of this more as a deposit because when I put this premium inside of the policy, then immediately it's giving me cash value, this green bucket. And then also immediately it's buying me a death benefit, this blue bucket here. Now, something I was kind of thinking about this morning as I was putting this together. Hold on, sip of coffee. So something I was thinking about is the death benefit. You'll notice on whole life policies designed specifically for the infinite banking concept, the death benefit is always a funky number. You'll kind of notice that because of how we go in there and we internally design the policy, okay? So here's something to note. Make this a little bit bigger for y'all. Here's something to note. In this example, I used a $25,000 premium, okay? Here's something to note on premium. You decide your premium that you want to do inside of your policy, okay? I ain't going to tell you how much to do. Whoever you're talking to about infinite banking shouldn't be telling you how much to do. I'll give you my suggestion. Hey, if this was me looking over your cash flow, this is what I would do if I was in your shoes. But at the end of the day, you're going to decide that premium that you want to deposit into the policy. And you can pay premiums. You can do monthly premiums, quarterly, twice a year, or even annually. So when I started this whole journey, I did a monthly premium. That's all I could afford at the time. Dad, even when he started his first one in 08, he could only afford to do monthly. So that's where he started. But he knew that he just had to start. See, sometimes some of y'all will make comments to me that you're like, Hannah, I need to wait until I have a big old dump in to put into the policy, or I'm going to save up and just wait to pay my annual premium. Really, what is the cost of waiting? Okay. I say it all the time on the show, specifically about like money, right? And stop trading your time for your money. Time is the only resource you can't get back. It's kind of the same thing with the policy, because the whole idea is get this money inside of this account as soon as you can, because now that money starts on the compounding clock, uninterrupted compounding that's going to happen forever and ever for the rest of our lives. So why are you delaying? Why are you waiting? I make the joke sometimes, hey, when was the perfect time to have your first child? There is no perfect time. The stars are never going to align perfectly. You just got to start, okay? As Nelson would say in his book, Becoming Your Own Banker, when was the best time to plant a tree? 20 years ago. When's next best time? Today. You know? So anyways, you decide your premium, and you can select even the different modes of premium that you want to deposit into. And could there be a first year dump in? Absolutely. Let's just touch on dump ins for a second. Sometimes y'all will ask me, Hannah, let's say that I want to not contribute to the 401k anymore, or maybe have a bucket of money sitting there at my savings account at the bank, and there's $50,000 there, and I want to take that 50 grand and dump it into the policy the first year, but I don't want to do 50 grand every single year. Can I design a policy that way? Yes. Answer is yes. We can hop on a one-on-one strategy call and talk deeper on that in your specific situation, but just high level, that's what a dump in is, and yes, you can do that. So here, I chose the premium of $25 a year. Why do I choose 25 a year? I don't know. It just matches my presentation materials and what I talk about quite often. So I know these numbers like the back of my hand. But here I'm using the example of 25,000 annual premium. That's what I'm putting in. This is my out-of-pocket money that's going inside of the policy. Now, here's what's unique, okay? Here's for my people who want to know the details. What makes this policy different is the internal design of the policy. So how that 25 of premium is being allocated is it has a portion going to the base premium and it has a portion going towards the paid up addition premium, PUA, paid up additions. This paid up additions premium, this is that moving part that allows us to have access to cash value immediately, month one, year one, out of the policy. So that's why it's so important that the majority of your premium is going towards those paid up addition riders, because that's how and why we have the cash value made access to us immediately within 30 days. So like year one of a policy, let's say that it's designed 10,000 to the base. And let's say that it's, and then let's say that it's 15,000 to the paid up additions. 10 plus the 15 gets us to the 25. Year one, I'll have access to 15, it's about 14 and some change, but let's call it 15,000 of cash value year one, month one. So if I want to, I can go in here and I can take out this 15 grand and then I can go and use it. My first thing that I would tell y'all to do within this strategy is if you have any bad consumer debts, not all debt is bad debt, right? But if we have any non-cash flowing bad consumer debt, even like my 0% credit cards, I love 0%, y'all. That's not bad debt. You know, if I can use free leverage borrowed money, I'm going to go use that free borrowed money all day long, right? But hey, is there student loans? Is there car payments? Are there credit cards that I just continue to roll over in the 20% plus interest rates, right? That's what I would tell y'all to tackle on first. That's where my family started. And that's where dad started to implement this strategy by paying off the debts first. Because the idea is get the control back into your hands, because I have to go pay those monthly payments, right? I got to go pay those monthly payments to the debt people. So if I can just pay them off and start to free up that cash flow monthly that I was sending to them, now I'm shifting the control back to my hands. And now I'm also continuing to keep the money that I'm earning for myself. So here's the whole idea, right? The reason that we're filtering the money through the policy first is because once our money hits the policy, I'm continuing to earn that uninterrupted compounding, right? We discussed that already. So if I go in here and pull out this 15,000, I am not withdrawing that 15,000. I'm taking out a policy loan. So what that means is I'm putting my death benefit, my blue bucket here, I'm putting this up for collateral and I'm taking a loan from the general funds of the insurance company. So really what I'm doing is I'm using their money in the real world, and that's how and why my money continued to grow and compound as if it was never even touched. This is what is called, my friends, opportunity cost. Okay, this is one of my favorite things to talk about. Why are you looking so funky, my friend? Anyways, opportunity costs, okay? One of my favorite things to talk about. How can I continue to have my money earn me interest, continue to work for me forever and ever. That's the whole idea. Go put the little green men to work. So what dad was doing is he was continuing to fund his premium. This is the new out-of-pocket money. He would fund the premium, take out the cash value, go pay off the debts that he had. And then once the debt was paid off, he would take that freed up money that he no longer has to send to the debt people, and he would redirect it back to himself. Now, here's a clarifying point I want to make, because this is a question I get a lot. Some people get confused of when you start to pay yourself back inside of your policy, where does that money actually go? Because sometimes, I don't know why y'all think like this, because I would go back and I look at all my content that I've created, but sometimes y'all believe that when you pay yourself back, it's going towards paying your premium. No. It's going towards replenishing your green bucket, your cash value bucket here. So when Brent paid off the debt and now he freed up all that money, he just redirected that monthly payment that was going to the debt people. Now he's sending it back to himself, paying back his policy, and it's going back into his green bucket. And now it's showing up as cash available again. So if he really wanted to, he could dip right back in the policy and take out the cash value again if he had a need for it. You know, there's no limitation to the cash value bucket. As long as there's cash value in there, you can go in there and take it out for whatever you want, whenever you want. So again, your money has to be stored somewhere. We're doing this through our policies and really maintaining the control and the ownership over our monies, the liquidity as well, instead of leaving it down at the bank or putting it into qualified accounts or brokerage accounts or et cetera, et cetera. There's different options of what you can do. It's just the policies are the foundation to our family bank. Okay, so this is where I'm storing it, or this is where I flow the money through my policy first. And then if I want to go make an investment, buy a business, send out some money for some marketing expenses, I will do it by using my green bucket here and sending out that cash value for that purchase. Okay. Now, I think y'all know this, but let me just kind of recap for any new people listening to me. So hi, good morning. Also, didn't mention this morning. I'm here every Thursday, okay? Every Thursday, 9 a.m. Eastern time, I am here with Money Mornings with Hannah. I will say this is my advanced show where I get into deeper money topics revolving around the infinite banking concept, real estate investing, structure, okay? Corporate structure as well. Been getting deep into that. Also taxes, okay? We're going to talk about some phantom income. Okay, stay tuned in this episode. We're coming up next. But 9 a.m. Eastern times, okay, every Thursday. And then also, if you don't want to wait for me on the live streams every Thursday, I also have the Money Multiplier podcast that goes out every Tuesdays on the YouTube channel, Money Multiplier, or wherever you stream your podcast at. So, death benefit, okay? Let's just touch on death benefit quite quickly. Because death benefit, like I mentioned, is always going to be there, okay? This is a whole life insurance contract, right? There's death benefit. Let's say over the course of this lifetime, we continue to pay our premiums year after year. We're building up the cash value bucket. And let's say that over, 15 years, we have built up our policy. We paid $500,000 of premium. We paid $500,000 of premium. We have built up a cash bucket of $700,000 at this point. And let's say our death benefit now is $1.1 million. These are all made up hypothetical numbers, okay? But you'll have your own numbers. They come directly from the policy illustration, but I want you to get the concept, okay? So over 15 years now, I've been funding this policy. Do you notice how premiums, this is the money that you put into it, and here's your cash value bucket? You do, okay? the whole idea is get to the fourth year and beyond, because by that fourth year in your policy, you're hitting your cash on cash efficiency points, that you get to the point where you're pulling out more from the system than what you even put into it. And hey, do you think the growth and the dollars that you're taking out are taxable or tax-free monies? Oh, they're tax-free monies, just putting it out there. But anywho's, let's say in 15 years, that you've been using your banking system, you've put in $500,000 of premium. This is your out-of-pocket money. You have a cash value of $700,000 and your death benefit is $1.1 million. Let's say that at the time of your passing, 15 years of doing this, you graduated, you passed away. And let's say that you have taken out $400,000 of cash value from your policy. That's what you've taken out from the system up to this point. Never paid back. Because remember, this is you. This is your banking system. Do you have to pay back your policy loans? No. But should you? Probably. It's probably a good idea. Anyways, so you've taken out $400,000 of cash value and you never paid it back over these 15 years. And you graduate, you pass away. What the insurance company will do is they will take your death benefit bucket, this $1.1 million, and they will subtract that $400,000 of loans that you've taken out, because they've already given you the money. Remember, your cash value, this green bucket, is nothing more than a prepayment of your death benefit. You're just using your death benefit early and while you're living. It's the equity, if you will, inside of the contract that you have access to. That's your cash value. So they've already given you the $400,000 and you pass away. They will take your $1.1 million of death benefit that they're already promising to your beneficiaries and subtract the $400,000 that they've already given you. 1.1 minus 400, that's 700,000. 700,000 is what's going to now get paid out to your beneficiaries, whoever you listed, lump sum tax free. By the way, did you know, and this is what we've been talking about over the course of this week, okay, as a family, this is where structure comes in, right? We have trust. The trust can own the policy. A trust can be a beneficiary of the policy. The trust can even pay policy premiums. Look into the Rockefeller waterfall method. Okay, there's some YouTube videos out there, or send me an email, hannah@themoneymultiplier.com, and I'll send you a copy of the ebook, What Would the Rockefellers Do? But there is a concept called the Rockefeller waterfall method, and this is exactly it, using trust and whole life insurance. So the trust is owning the policies, paying premiums, and then when that person, okay, because at the end of the day, the policy always has to be on an insured body, right? The death benefit has to be on a living organism, right? So when that person passes away, then that death benefit will get paid to the trust. And now what the trust will do, if the people who's operating the trust are smart and write this into the verbiage of the trust now is going to use that death benefit money, and they're going to go out and purchase more whole life policies designed for high immediate cash value on the next generation in line. So now they're starting new and more banking systems and getting these policies as old and efficient as and matured as possibly can. Okay, grammar, what, Hannah? That came out weird, but y'all are following me. So this is what we've been talking about, right? Because here's what we've been doing in our own family banking system. I mentioned Dad first started off in this journey paying off his debts with it, right? So he was paying off the debts. Then he started to finance for the purchases within the office using the system. Then he graduated up and he started to use policies for his retention of his employees, okay? Go back to a few episodes here on Monday mornings. We talk about employee policies, okay? but he had employees, and so he would actually offer benefits using whole life insurance to his employees instead of offering like qualified plans, 401ks, IRAs, et cetera, right? So then he did that step. Then he was using the policies to help finance for kids, okay? When I bought my first car, how old was I? Was I 16? I was 14 when I got my permit. When did I buy my first car? Maybe I was 15 and a half or something. I had a Nissan Altima. It was a gray 2009 Nissan Altima. That was my first ever car. And I remember we found that car on Facebook Marketplace on an ad somebody posted, and they were right there in the neighborhood with us. And I remember they sold it for $9,000. That was my first car. And so what Dad did is he used the cash values from the policy, bought the car for me, and then I was actively working, so I was paying Dad monthly payments for my car. So that was how he taught us to use this system and to pay back the family bank. And then when I moved out, I was paying rent, okay? I had my apartments. I moved out to Shawnee, Kansas was my first apartment. Then I moved to downtown KC. I was living with 2 girlfriends down there. And then I moved to Florida in 2019. And when I moved to Florida in 2019 is when I bought my first house. And it was a duplex, okay? And the purchase price was $150,000. And Dad came in and financed for that duplex for me. And now Dad was teaching me how to use the family bank by buying houses. He was my mortgage holder. And y'all, don't get it twisted. This is business, okay? He went down to the county and filed that note with the county. Even though I'm his daughter, you got to protect yourself. He says, honey, I love you, but it's business. You know, if you're not going to pay me just like a regular bank would, if you don't pay your mortgage payments, the banks are going to come and foreclose on you. I'm obviously not going to, I'm going to make sure that you're not on the streets, but hey, if you can't afford this place, then you can't live here, right? It's just the reality. So he actually went down, he filed the note with the county. And so he held that first lien position on my house. And then I was paying Dad my monthly mortgage payments. So as we progressed through life, we just continued to buy things. We would even sell things when Dad would, you know, because he's had different, you know, he's a aviation enthusiast, right? He's a pilot. So he's had different airplanes in his lifetime. So when he sells an airplane, has those proceeds come back to him, he has a place to warehouse that money inside of the policy. And he just simply goes in there and replenishes the policy loans, AKA the green bucket, the cash value bucket, right? So when an opportunity or something else comes up that he wants to go fund for, the money's there and he can go and deploy it. He doesn't have to ask for permission. He doesn't have to qualify for the policy loan. It's literally the insurance company asking, do you want a paper check sent to you? Do you want a direct deposit? And how much do you want? Or do you want the max loan that's available right now? Those are the 2 questions that they ask. So anyways, why I'm getting on that point is I'm kind of thinking about how important it is to have a place to store windfalls in our lives. You know, that's something else that a lot of us don't talk about, but like, why does my mind want to go down the morbid road? My mind is going down, well, when mom and dad pass, there's going to be some inheritance money coming in. Where do you store that inheritance money at besides at the bank? That's a little morbid. Let's say like when you sell something, okay? Let's say that you are selling your house or you're selling a car right now and you're going to have a windfall. That's more happy vibes, Hannah. Take that money and have a place to warehouse it somewhere within your system, right? I think that's always important too. So that's how we progress, you know, ever since 2008 in doing this, we just do it in our own lives actively. So now, as I mentioned, we've been financing for purchases throughout our life, okay? Let me add this back to stage for a second. And let me scroll down here, okay? Here's my cute little family. All right, so I have a younger brother, Zach. I put this in age order from youngest to oldest. I have a younger brother, Zach. There's me, and then there's Sean. So I mentioned that I've been buying houses. I've financed cars. I've even like financed some investment deals with dad. Like I needed like some gap money for this funding that I did back in April. And I said, Dad, I need a little bit of funding. Can you just lend me some money for 30 days? Obviously, he did charge me interest. Dad's going rates for the family is 13% interest. So I did have to pay him 13% for 1 month of interest. Okay. Again, I love you, honey, but this is just business. but we have gone through life and we're financing things through the family bank. So Zach, for instance, Zach has bought houses. His first house in Florida, he financed from the family bank. Dad's charging him interest and he's paying it back. I explained myself, even Sean, right? Sean has bought in houses. Sean has even bought in some jet skis for his business down in South Florida. He runs a property management business, which, shameless plug, you should all look up. Oh my goodness, why am I blanking on it? Captiva Beach Sunset.com. Everyone should look up CaptivaBeachSunset.com. It's an amazing place to take your family. Go look it up. And it's on an island. It's really, really cool. It's on North Captiva Island, right off the coast of Sanibel, Fort Myers, Pine Island, St. James City down there. Okay. But beautiful, beautiful place. It's a really cool island. You can go there for a week with the family. It's very peaceful. There's no cars on the island. You get around by golf carts, and that's it. And how you get to the island is by taking the ferry or coming in on a small airplane, and the small airplane lands on a grass strip. It's a really cool place. But anywho's, Sean has even financed things with Dad through his own businesses, his life, his house when he bought it, I want to say almost 10 years ago, moving from Pennsylvania down to Florida. So we've all gone through and we were using this family bank here. So let's make believe that over the course of the lifetime that Zach has paid in interest to the family bank $100,000. That's what Zach has paid in interest to the family bank. And let's say that Hannah has paid $250,000 in interest to the family bank, and Sean has paid $300,000 of interest to the family bank. Again, I'm just making up these numbers, y'all, okay? Just want you to get the concept. And mom and dad pass away. Because remember, there's a death benefit bucket, right? It's not an if it happens, it's a when it happens. Over the time that we've been using this system, this is how much interest we pay back to the family bank. And let's make believe that there is a $40 million death benefit bucket between mom and dad. Now, you may be thinking to yourself, Hannah, 40 million? What do you mean? That is crazy. You got to understand, within the Kesler family, we have over 40 policies, okay? This is just our scenario. Your scenario may be different, right? But you got to start somewhere, okay? When dad started his first policy in 2008, $2,000 a month, hell no, he did not have 40 million in death benefit, right? And I'm combining mom and dad together here in just this example. So what will happen is that there's going to be death benefit money that gets paid out. How that death benefit money gets paid is it's going to go to the trust account. It's going to get paid to the family trust. And written inside of the family trust, the first thing that it will do is pay back Zach $100,000 for the interest he paid to the family bank. It will pay Hannah back $250,000, and it will pay Sean back $300,000. That's what the death benefit money will do first. And then whatever remaining leftover pool of money, that's what's going to get divvied up equally to each child. But we're not getting paid that money directly. That money is staying within the trust. And what dad has done is he's put verbiage within the trust that if and when we want to borrow from this trust because obviously, you know, there's going to be trustees that move up as we add more people to the family and subtract more people from the family. But there's written verbiage in there that you cannot just willy-nilly go in there and borrow from the family bank. You have to have a strategic game plan. You have to use this money in a smart, I wanted to say smartified, in a smartified way. There's some precautions that are set there, okay? Because I know like sometimes like some of y'all voice concerns about, Hannah, I'm just really, really nervous because I'm the only financially responsible person in my family. And I don't want to just leave this crap load of death benefit to this family member that I know is going to go in there and piss it all away. So this is where this trust structure and making sure that your assets are protected is kind of important. I'm doing this at 27 years old, y'all. Okay. I think it's important to get clean, to get into a correct structure, make sure you are in alignment for the purpose of estate planning, taxes. How can I minimize my taxes even more? So this is the whole idea when you're putting together the family bank is how can I protect this? And so it's kind of funny. Like I said it, I think even last week, where you kind of get to this point within your wealth building journey that, yes, I want to continue to go and make money. I love to go make money, right? I just posted a reel yesterday. I sat my butt on the boat on a Wednesday afternoon, right? Because I can, my money's working for me. And I want my money to continue to work for me. I want my little green men to be out there working. But for me, as you continue to advance up, it's so much more important to keep that money that you already have and that you are already making. You see what I'm saying? Again, yes, it's important to go make money, but it's just as important, if not more important, to keep that money. That's where the true wealth building happens. And how can I do that? Again, I can do that by filtering my cash flow through my whole life policies and my banking system, because now I'm never losing out on that opportunity cost and the interest that's going to be earned on my money forever and ever. And that's what really keeping control and keeping the wealth in the family. That's what this means. So then, you know, government, others, probate, they ain't coming in with their sticky little fingers and trying to nag at all of your stuff. You know what I mean? That you built up over this point in your life. But even if you do nothing, right? We're getting here to the top of the hour, but I got more thoughts, okay? Because I wrote it like in my notes, how we're using this in our own family bank. Debt, financing, retirement. Let's touch on this just for a second, okay? The family and I have been reading the new Robert Kiyosaki book, Why the Rich Keep Getting Richer. Great book, by the way. Okay. Him and Tom Wheelwright wrote it together. We got introduced to Tom Wheelwright through Robert Kiyosaki too, in his book, Tax-Free Wealth, because Tom Wheelwright is Robert Kiyosaki's CPA. And I'm like, how is this man not spending all this money to the government and the IRS? How is he minimizing his taxes? Okay. I need help with that. So that's how we got turned on to this Tom Wheelwright guy in that book, Tax-Free Wealth. And so now we're on the phase 2 book, his newer book, Why the Rich Keep Getting Richer. And they're talking about phantom income is what they call it in the book. I personally call this invisible income, but I kind of like the word phantom. It's cooler. So the whole idea, right? Okay. Now we're at the point where, yes, we're going through life. We can finance for purchases. We love doing that. And we are being disciplined. Let me say this too, y'all. Is the infinite banking concept for everybody? Absolutely. It can be for everybody, but should everybody do it? No, because not everybody's disciplined with the system and disciplined with their money. The only person who can screw this stuff up is you and how you use the system. And who do you know better than you? But we are continuing to do the boring mundane stuff, if you will. I mean, when I go in and I buy things for myself, I'm paying myself back every month. I'm charging myself interest, right? I'm not neglecting those foundation building blocks that got me to this point. I'm just continuing to expand. I'm still doing the same habits and discipline I've been doing since 18, but now I'm just expanding off of that. So don't treat your money like it's free money. Pay yourself back, be disciplined with your system, right? So we're continuing to do that. Now we're using the system to buy cash flow and assets, right? I want to go put my little green men to work. And so this is where I love real estate so much, is because I can actually use the tax code, depreciation. I can do some cost segregation studies. I can use the tax code and have it hedge, if you will, against my active income. So then I can keep more of the money that I'm making. And that's the phantom income. And that's the invisible income that I'm trying to get to with my policies. I can do this the same way, creating that phantom income. Well, let me bring it up. There you are, Paige. I can do the same thing here with my policies and creating this phantom income too, because with the money that I put into my policy as premiums, this is after tax money. After tax money goes into this system. And now the growth on cash value and death benefit, this is tax-free monies to me. So when I'm to that point that I am pulling out more than what I put into it, that's all tax-free dollars to me. So this is also phantom income that I can strategically use this system as my cash accumulation bucket and warehouse, that I could draw down on this to supplement my income during retirement or whenever I want. Retirement's not a number, in my opinion, meaning like an age. Retirement's not an age, it's more of a cash flow number. But I can use this as a place to accumulate the wealth. And over the course of how I've been building this up over the years of my life, I'm hopefully buying myself cash flowing assets. So now I have the cash flow from the assets that are coming in, funding my lifestyle. Plus, I got this bucket of cash value that I can tap in here and start taking out that tax-free income if I wanted to. And then, the analytical side of my brain is kind of going down the road. Well, should we now start talking about loans versus withdrawals? Because you can withdraw money out of your policy, just FYI, that is an option. But we'll save that for another time. I think this was enough information for today. But I just want to add some clarity, okay, around like the different buckets of your premium, your cash value, your death benefit. That's all that there is, right? Okay. And don't overcomplicate this stuff, y'all. I'm telling you, it is really that simple. Okay. I sometimes struggle in creating content for y'all because I'm like, guys, it's that simple. Like, what do you want to see? I know everybody wants to see their specific scenario, and we can do that. I'm happy to do case studies. I've done case studies on the live show before, but the only difference, right, between you and myself, we are just putting different premiums into our policy. That's the only difference. We're putting different premiums into our policy, and how we're using our cash values are just different. But we have the same buckets. We are all putting our premiums into the red bucket. We're taking out our cash values from the green bucket, and there's always going to be a death benefit on that policy, whether we like it or not. It's just, what am I doing as my premiums, and how am I using the cash value? That's the only thing that's different between family to family, person to person, okay? So that's a little update. That's what we've been kind of doing over here with our banking system. I mentioned a few weeks ago, Zach and Summer, they bought their boat. That was their big purchase for the year, using their cash values. I bought my van. So that's what I've been doing, is fun toys. But hopefully this was insightful. Hopefully this started to get you to think a little bit more, but you just got to start, y'all. Okay. Just stop kicking the can down the road. you guys tune into the show. I know y'all want to do this. I'm thinking about a few people in my mind who keep hitting me up, but for some reason, y'all just ain't getting started. And it's like, why? You know, you're in control of the system. You get to choose your premiums that you want to do. What is the worst thing that could ever happen inside of this is the money just grows. If I never use my whole life policy, if I just continue to pay my premiums and I never even touch this thing, and I just take this policy and I stick it in a drawer and I don't do anything with it, what's the worst thing that can ever happen? It grows. You get a contractual guaranteed interest rate and you have dividends that get paid out. Plus, you have the death benefit. That is the absolute worst thing that could happen. But at the end of the day, you're in control of the system, you know? So, okay. Dave says, I like smartified. Good. Oh, good, Daniel. He's saying Hannah makes it easy. Good. I'm happy. Okay. Well, thank you all. Thank you for being here on another episode. Here's the thing. Follow me on my social media channels because I don't know if I'm going to be here next week. I do have a flight out of Daytona at 12:30. Oh, which is a perfect segue. Hey, come and join me. I'm going to be in Cleveland next weekend. Yes, it's over Labor Day weekend. Come and hang out with your girl if you're in the Cleveland area. It'd be great to see you and meet you. We can go out for a meal or have a bite to eat, or dude, let's go do something fun. We could go bowling. We could go to the arcade. I like to go do fun shit. I'm just saying. But I'll be in Cleveland. There is a live speaking happening, the Home Care Symposium, right there in downtown Cleveland. So I'll be out there. I'm getting in on Thursday. I'll be heading out on Monday. So I don't know if I'm going to be here next week just because of my flight, but I'll keep you posted. How you'll know if I'll be here or not, follow me on Instagram or Facebook, and I'll be posting it out on there. Hannah_Kesler. Hannah spelled the same way forwards and backwards. Kesler with one S. All right, y'all, be well, do good, have some fun today. And as always, I believe in y'all and you're doing good, okay? Just stay intentional, stay on the forefront of your money, your mindset. And as always, too, I keep saying, go have some more fun, okay? Have fun in this lifetime. All right, have a good day. Mwah. Bye, everyone.